Welcome back to the channel. Today we are going to talk about a question that almost every beginner asks when they first enter the world of financial markets. What is the difference between trading and investing? These two words are often used interchangeably, but they are actually very different approaches to making money in the stock market. Understanding the difference will help you decide which approach suits your personality, your goals, and your lifestyle. By the end of this video, you will have a very clear picture of both. Let us get started. Investing is a practice of buying assets, typically stocks, mutual funds, or bonds, and holding them for a long period of time, usually years or even decades, with the expectation that they will grow in value over time. An investor is not particularly concerned about what a stock does today or this week or even this month. An investor looks at the big picture, the long-term growth potential of a company or the overall economy. The legendary investor Warren Buffett is the most famous example of this approach. He buys stocks in fundamentally strong companies and holds them for decades, sometimes forever. His philosophy is simple: buy great businesses at fair prices and let time do the work. Investing relies heavily on the power of compounding, where your returns generate their own returns over time, creating a snowball effect that can build enormous wealth over long periods. Trading, on the other hand, is the practice of buying and selling stocks or other financial instruments over much shorter time periods with the goal of profiting from short-term price movements. A trader might hold a position for a few seconds, a few minutes, a few hours, or a few days, but rarely for months or years. There are different types of traders based on how long they hold positions. Scalpers hold positions for seconds to minutes and make dozens or hundreds of trades per day, targeting tiny price movements. Day traders open and close all their positions within the same trading day. They never hold positions overnight. Swing traders hold positions for a few days to a few weeks, trying to capture the swings within a larger trend. Position traders hold for weeks to months, sitting somewhere between traders and investors. Trading relies heavily on technical analysis, reading charts, patterns, and indicators to predict short-term price movements. Let us now look at the key differences between trading and investing side by side. The first difference is time horizon. Investors think in years and decades. Traders think in minutes, hours, and days. The second difference is the type of analysis used. Investors primarily use fundamental analysis, studying a company's financial health, business model, and growth prospects. Traders primarily use technical analysis, studying price charts, patterns, and indicators. The third difference is the frequency of activity. Investors make relatively few decisions. They buy good assets and hold them patiently. Traders are constantly active, monitoring markets, making decisions, and executing trades throughout the day. The fourth difference is risk and stress levels. Trading is generally considered higher risk and higher stress than investing, because short-term price movements are much harder to predict than long-term trends. The fifth difference is the skill set required. Investing requires patience, research, and a long-term mindset. Trading requires quick decision-making, strict discipline, emotional control, and deep knowledge of technical analysis. So, which approach is right for you? The honest answer is that it depends entirely on your personality, your available time, and your financial goals. If you have a full-time job and cannot monitor markets throughout the day, investing is almost certainly the better choice for you. Buy fundamentally strong stocks or index funds regularly and hold them for the long term. Time in the market is more important than timing the market. If you have the time, the discipline, the emotional control, and the willingness to learn, trading can be a rewarding pursuit. But be honest with yourself. Most people who try active trading end up losing money because they underestimate how much skill, discipline, and emotional control it requires. Many successful market participants actually do both. They have a long-term investment portfolio and separately allocate a smaller amount for active trading. To summarize, investing is a long-term approach focused on building wealth over years and decades through the power of compounding. Trading is a short-term approach focused on profiting from price movements over minutes, hours, or days. Investing relies on fundamental analysis while trading relies heavily on technical analysis. Neither approach is superior. The best approach is the one that matches your personality, your time availability, and your financial goals. Whatever you choose, educate yourself thoroughly, manage your risk carefully, and never invest or trade money you cannot afford to lose. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.